So now all of a sudden the dollar is coming back to us.
Right.
So we don't have that purchasing power anymore. And so Trump's like, okay, I've got to get all of our current account balance in order. So he's looking at the European Union and saying, we're sending too much. We're buying too much and not getting enough back. He's looking at China going, we're buying too much and not getting enough back. He's looking at all these relationships going, we need to balance the checkbook here, because we don't, we're going to fail.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. We have a very exciting discussion lined up today that I'm very eager for. Today, we're fortunate to have with us Rob Kientz, founder of Gold, Silver, Pros, and the Freedom Report podcast. Rob, welcome back to Metals and Miners, and thank you so much for joining us today.
Hey, Gary, thank you so much for having me on. I know it's been a little while, but I really enjoy the opportunity to be on your program, so I appreciate it.
Wonderful. Yeah. All right. So, Rob, with the stock market trending down, recession fears intensifying, and economic experts warning of a shift from U.S. exceptionalism to U.S. repudiation, we're now seeing signs of a buyer strike in U.S. assets and twin pressures from both the bond market and even the electoral base, pushing for a reversal in this, tariff and trade policy that has ignited the firestorm over the last month. How significant is this shift, and what does it signal for the future of the U.S. dollar, especially in the context of global capital flows and investor confidence?
Okay, so I'm going to continue a part of the conversation we were having before we hit the record button. It was a fascinating one. What you're seeing is really the end of this currency cycle. The dollar for about 57 years has been a pure fiat. It's been the dominant world currency for even longer than that when it was on the gold standard. And typically at about this point, currencies fail. In addition, if you look at the 250-year nation-state cycle, the U.S. is at a critical juncture that all predominant nations have been throughout human history, regardless of where they were or how they were formed or what language they spoke, which is at about this point, you get to a point economically, politically, culturally, where you have to do a reset. And that's why the talk the last few years of what is the reset, what does it mean? We're resetting the global monetary system. We're resetting geopolitical alignment. We're resetting some cultural norms that have been in place for a long time. And so what you see is all of this change that people are having a hard time kind of grappling with. And it has led to an inflection point at which Trump comes back in, and he realizes we don't have a lot of time to deal with the economic pressures and the currency pressures. So what have we seen? Dating back to earlier talk this summer about the Bitcoin reserve. I was at Nashville Bitcoin conference when Trump announced it, and Ramaswamy and I think it was the Wyoming senator came out and talked about it after. And now we're seeing the overt changes in the stance of the U.S., which are different, and it's kind of freaking people out. You see big moves in the markets because people are like, wait, this is new. And the way in which the market reacts, typically the market reacts more around what the Fed does than what the government does, although the government is now asserting more control. And one of my friends who's a great analyst was telling me, he's like, now we're in the era, Rob, where government's going to assert more control over the currency in the banking system. Because why? Because the currency is failing. And the banking system is coming under pressure, and the government realizes that. And that threatens government power. Because if you look back in history, it was government power along with something else, and it's the church power, right? The Pope and the King. But also there's that banker power, and that's been the more silent underlying power that has affected politics and economics. And you're starting to see it come back. So what we are right now is we're going through a currency change. The United States will no longer be the predominant currency. We're going to multipolar format where you're going to have different currencies competing. And what's happened though, the dollar's got so long in the tooth that it got so strong that we were able as a nation to afford more. So we spent more. We sent more of our dollars overseas. And as long as the countries were okay with the amount of dollars they're holding, it's all good. But now they've said, the World Gold Council study in 2023, the central banks are removing dollars. So now all of a sudden the dollar is coming back to us.
Right.
And so we don't have that purchasing power anymore. And so Trump's like, okay, I've got to get all of our current account balance in order. So he's looking at the European Union and saying, we're sending too much. We're buying too much and not getting enough back. He's looking at China going, we're buying too much and not getting enough back. He's looking at all these relationships going, we need to balance the checkbook here, because we don't, we're going to fail. And one way he can do that, the easiest way for a president to do it, is to issue a bunch of tariffs. And to some extent, for the people that had less bargaining power in this economic relationship, it's worked. They've all conceded, like Canada, Mexico, you see them all conceding, Ukraine, anybody, Europe, they've all said they're going to work with the U.S. And China is not, because China has a lot of economic power now. And like, no, you're not doing this to us. Because if China allows the U.S. to run large tariffs, it's going to crater the Chinese economy, because they're still an export economy. They're changing to a consumption economy, but they're not there yet, domestic consumption. So China is at a vulnerable point, and China and the U.S. are both at vulnerable points. The U.S. is vulnerable that if China dumps treasuries on the dollar, it could crash the dollar. China is vulnerable that if the U.S. realizes this and does something about it, and amps it up like Trump is doing, because he feels like he has to save the dollar and to save our system, then China's vulnerable, because their trade and their current account balance and how they fund their industry is now vulnerable. So now you're looking at potentially a deflationary crash in China if these tariffs keep going. And over history, if you look back to Smoot-Hawley and you look back to all these times in which tariffs have really, it's been this sort of battleground, is you see great economic change, and tariffs tend not to be great long-term. They're used as short-term defensive sort of things. And so the question will be, the executive orders, the tariffs, all that stuff, how long will that exist? Will it accomplish its mission? Will it allow us to kind of retool and rebuild? I think not. And so I think we're entering a period of increased volatility, and that's affecting markets. And you see it. You see it with the bond rates fluctuating. I mean, bond rates, it's like the 10-year almost goes up between 5 and 4.2 or 3 very quickly. I mean, that's a huge swing. And, you see it in the markets. You saw the stock market crash down, and now it's starting to recover. The whole system is looking at trade and currency and saying, if this doesn't go our way, we're in trouble. And it's the realization across the world that as the battle begins, this almost moving into a Cold War period between the U.S. and China begins, which was inevitable. We had the dominant currency. They're the rising nation. We're going to fight, right? We're jockeying for position. We're jockeying for future dominance. It was inevitable that we were going to see this, and we're just in that era, but people weren't used to it. They were used to the stock market always going up, bonds always having a certain yield, the United States being able to buy whatever we wanted and having this runaway lifestyle. And all of that is starting to come back down to reality, where the bubble's starting to crash. And it's just interesting to see, Gary, how the entire world reacts to that. It's been fascinating. It's scary, but also fascinating at the same time.
Yeah, and so that's really well put, Rob. So with this battle that is starting to take shape that you just described, is a recession inevitable? Based on historical data from Goldman Sachs, structural bear markets in the U.S. since the 1980s have seen an average decline of about 50%, compared to 30% for cyclical and 25% for event-driven bear markets. So do you believe that we're entering a structural bear market because of the dynamic you laid out? And if we are, is it your expectation that we're going to see a similar 50% decline in the markets?
I'd say yes and no, and I've got to preface this with, we're living in a different world from a data standpoint. So calling recessions now has become much more difficult and much more cloudy. If you look at statistics from the 1980s, from like the 40s to 80s, our statistics on CPI, employment, all that were consistent. In the 80s and 90s, they started changing it. I've talked about this extensively in my book, Drop Shadow. On our advisory board for Citizens for Sound Money, which I'm on the regular board for, we've recruited John Williams of Shadow Stats, and I get his report every week, and he goes over what I consider the real numbers. He uses 80s structure so that you can consistently compare periods. And if you look at it, we've been in a recession. We've been in some sort of recession since 2008 and the mortgage crash, if you look at conventional data. But you can set that aside. Let's just use the CPI the government wants to use, because that's what everybody's going to talk about. Everybody's forgotten the Q6 numbers on unemployment. Everybody's forgotten the old data measures. So let's just use the new ones. We have not had a sustained period of real growth in wages or in net worth or in asset values that has eclipsed inflation since 2000. And the way that you tell that is by looking at gold. Gold has beaten the stock market indices, real estate, all of it since 2000. And particularly the last couple of years, gold is stomping everything else in the market. It's kicking it, it's beating it, it's taking a baseball bat to it. So it's obvious that in real terms, in a real limited asset sense, that we've been in some sort of recession from a purchasing power perspective. Now, you can talk about government numbers all you want, but purchasing power-wise, people are suffering. That's why credit card balances are up, auto delinquencies are up, credit card delinquencies are up, and not only that, last month, about 2 or 3 weeks ago, a report came out that this is the worst real estate market in 65 years, all factors considered. And this was considering real estate, publicly available real estate data, prices, affordability index, and insurance rates, all of it, interest rates.
And I'm not sure if you're familiar with the FHA loan modification program and what is going on there, and that it just got stopped. But that is an absolute travesty. And there's a significant amount of homes that could be facing foreclosure coming very soon because of that.
Yeah, so I've got a little anecdotal story I'll give you in a sec after I finish answering a question, because I'm buying a home and I have an FHA loan, and I want to tell you about my experience, because I can tell you how crazy getting an FHA loan is. It's crazy. So anyway, finishing off, I think we're in a recession, and yes, we're going to have another one. Now, people ask me about timing. I'm like, it doesn't matter. I'm like, Rob, why doesn't it matter? Because if you're not preparing now, you're dead in the water. I don't care if it happens 2 or 3 years from now or tomorrow. You will not have enough time to restructure your own balance sheet, to restructure your mindset into how do I live in a limited expansionary world or a deflationary world. And the way that you invest, the way that you manage your bank account, the way that you spend money is going to change. And so, yes, I do think we'll have big corrections. I've said some people think it's going to happen second half of this year. I've had people on my program that are very smart that have said that. Elliott Wave people and just market observers. Goldman, from a gold perspective, came out and said gold could hit 4,500 by the end of this year, not next year. That would be a 50% increase from the beginning of the year where gold was at. That's astounding that a bank the size of Goldman came and just rang the bell of gold and said, yep. And so what does that signify? When money goes into gold, where is it coming? It's rotating out of the rest of the market. And you can see it. You can see it when London basically defaulted. London had what I call a soft default. So I not too much time to explain this, but in the London gold market, it's OTC. So not every ounce has one claim on it. It's every ounce has maybe 100 claims on it. And it's only when people want delivery that you exercise that gold and take it out. Well, that happened a couple months ago, and they were running 8-week delays on being able to deliver it. And that's the largest and oldest gold market in the world. And so it came to the COMEX, and COMEX has had trouble delivering. They haven't been able to deliver their contracts, their cash delivery. So the world is asset cycle rotating, or investment cycle rotating into gold at a level we have not seen, I dare say, since World War II times and after World War II. And this is an 80-year rotation into gold, even more than 79, 80 when you had big inflation.
And when you think about the amount of assets globally, I mean, this thing hasn't even started, and it's moving like that.
And that's what I'm telling people. The $4,500 revaluation of gold, or target for gold for this year for Goldman Sachs, is them saying we're in a new era. When you translate that banker speak, they're saying we're out of the old era, we're into the new. So we know we're there, and we know the central banks and the wealthy people are front running it. So if you're watching this video, you know it's coming very, very soon.
So you believe a systemic reallocation rotation into hard assets, gold and silver, and probably commodities, amid this eroding trust in fiat, is basically underway and will only intensify probably in the years to come. So this is a stampede that's coming.
This is the rotation that everybody thought that gold and silver were going to have in 2008. Yes, to answer your question. And if you look at what the president's doing, he's got Ludnick and Besant setting up a sovereign wealth fund with what? Bitcoin and gold to support what? The dollar and treasuries. The government's already acknowledged that the entire dollar game has changed. They've done it in a way in which they're not saying the dollar is going to crash and we're going to have a multipolar currency world. They're saying we're taking every national asset we have and backing the dollar and treasuries. Why are they doing that? Because they know it's coming, and they know capital's rotating into those assets, and they're going to use that to their advantage to stave off the eventual dollar failure. It eventually will fail, but they're going to try to buy time. the president of the United States, the Commerce Secretary, and the Secretary of the Treasury are telling you it has changed. At the day that Trump came into office, he basically announced, this has changed. We're in the new era. And he did it explicitly, so loud that you couldn't not hear it. It was the actions, the what do we call it? The shot heard around the world. Let's call this the executive orders heard around the world.
Little
He
baseball analogy
said,
there.
everything changes.
Yeah.
And going back to my FHA story real quick, I'm getting buying a new house. First time in 4 years, been living in an apartment. So excited. Getting a house again for the first time, single dude, right? And it's an FHA approved loan. I have been to heck and back for this loan. I had all my documents in 30 days before close. And it's been, hey, Rob, your bank account, you paid $8 more in rent this month than last month. Justify that. And I'm like, well, yeah, it's the water charge. I literally had to go I had to go to my apartment and get their individual accounting and hand it over to get approved. And I've had to bend over backwards. The FHA, I can tell you right now, the loan market is so scared of default. We're the opposite of no income, no document loans that you heard about. Yeah. We're in, if you want to get a loan with us, you have got to prove beyond a shadow of a doubt that you can service this loan. And we're going to require 3 times more paperwork. Yeah. And my real estate agent, my lender even, and everybody is saying all the changes in FHA requirements are so onerous that it's literally having the effect of slowing the mortgage market down. The FHA has put so much requirements on a new loan, it has dropped, they're saying maybe by half or more, the amount of people that can qualify for an FHA. And I want people to understand how impactful this is. The reason I know the real estate market is about to go big time crash, the only time that the FHA and Fannie Mae and Freddie Mac have ever done this kind of stuff is when they know a crash is apparent in the market, because they have all the data and they know what the servicing rates are. They know because the government subsidies the entire real estate market, and they know, and they're trying to slow it down because they know the crash is coming. And it's only the most creditworthy borrowers that are going to have a shot at getting a house. What does that mean? The real estate market has to collapse. The easy money period is over. We're now going into a period in which the real estate market has to collapse, because the biggest underwriter and supporter of that market for the last 20 years has been the government, and the government has hit the brakes, and they said enough is enough. Yeah,
and to your point, I mean, you are describing credit contraction, and when credit contracts, the economy contracts. It's just that simple. It's just that simple. So we're talking. So it sounds to me like you believe deflation is on our doorstep.
Deflation's on our doorstep. They know it, and so they're going to inflate by printing, but they're also trying to build up other assets to help support that. They're going to use the gold and revalue it and shove all that money at the dollar in the treasuries to keep it from crashing. One thing that people may not know is about a week or so ago, about a week to 10 days, Mnt&x came out and said we almost had a freeze up in the repo market. Now, I don't know if your listeners are up on all the intricacies of the last 2 recessions, but in 2008 and in 2000 and in the Great Depression, and in each case, the short-term lending markets froze up before, so we know that the history of the short-term markets freezing up is not good. Right. It means, and we got this close. And what happened was, if you put the pieces together, Yellen said on the way out, I had to manipulate the short end of the curve, which is why she's doing all of her open market operations on the short end of the curve. And she said, I stopped the next big recession, which probably would have been depression. She said it publicly.
I'll tell you what,
covered
now that you're, talking about this and laying it out, it would make all the sense in the world for Powell not to front run that and to allow it to start to spiral, because then he could pin the tail on the donkey on Trump, rather than if he front ran it and got ahead of it based on the data and said, okay, this is what I see coming. It would be off Trump's, plate. So to me, it seems like, if they're going to be playing politics here, it would make sense that Jerome Powell is going to wait until we actually, see this thing sliding.
Yeah, they did. And Yellen tried to save it. And then when Mnt&x came in, he couldn't do the things on the long end of the curve he wanted, because they have something like $8 trillion coming due this year and next in Treasury debt they're going to refinance. And the long end of the curve is too pricey, to the point where it could be very difficult for the. So they've come out with different schemes. They want to do a 50-year non-interest paying bond. They want to do all these things to where
Gold
they
back
can just
though.
focus on the interest and not the principal and reduce their default risk. Well, the market's really not going to take that. So what you're seeing is you're seeing the end of this big debt era, and the U.S. trying to do everything they can to stave off the big collapse. Whether or not they're able to do it, that'll be the legacy of Trump and who comes after him. Mm-hmm. And also be the legacy of the current Treasury Secretary, the current Commerce, everybody, the Fed.
Okay,
but what you're seeing is the government trying to take control, saying, okay, we went too far with this banking system. Now we got to try to rein it in. But is it too little, too late? I think it probably is. But the next few years are going to tell us what the playbook is, and how all that kind of plays out.
I mean, it's really interesting. It's exciting times from the standpoint of stepping back and, if you're not being affected, but it's really scary times, as you talked about, because everybody's going to be affected. But from a historical standpoint, it's kind of exciting to be living through it. But I'm not I'm not looking for pain or anything. So, all right, we're seeing this rotation into gold. You're talking about how it's just at the beginning of this massive stampede. There's a tremendous amount, exponentially more of assets than ever before in history. So if you look back to the 70s and during that time frame, this moment in time dwarfs in terms of assets. And also back then, the potential for gold ownership was so minuscule because you weren't allowed to own gold in the United States up until, 74. Other countries didn't allow it. There was a lot less millionaires and billionaires around the world, and a lot less people who even had retirement accounts separate from their jobs to protect. Today, we have a completely different ball game. We have the potential for a historic stampede. So, Rob, annual global gold mine production, it's minuscule relative to these major financial markets. So it's just literally 0.21% the size of the global stock market, and only 1.43% even the size of Mag 7 companies' combined market cap, which is unbelievable, right? So the global gold mine market is incredibly tiny compared to the financial assets under management, which is 128 trillion, and the global stock market, which is 124 trillion. So given that gold production is dwarfed by nearly every major asset class, and the central banks are increasingly accumulating gold as a strategic reserve that you talked about earlier, how might a relatively even modest shift, say 1 to 2%, in global capital allocation towards gold affect this tiny market both structurally and price-wise?
If you had that much of a rotation into gold, it would bankrupt both Western markets, the London and the COMEX, because they run on a fractional reserve, derivative, or over-the-counter type of scheme. They're different schemes with similar overall arching effects, meaning they're not going to be able to deliver the gold. And if the money comes in like that, those markets literally cease to exist. They'll still operate, but nobody's going to put money in them. You'll see the shift over to Shanghai and Dubai, and in Japan and Russia running the gold markets. And that's huge because the Western powers have owned the gold markets for over 100 years. In fact, probably several hundred years if we're really dating back. And that's about to shift east.
So that is your base case?
Yeah, that's the base case. And the valuations on gold or in fiat terms, people won't understand them. You're going to look at 40, 50 down. And what it really is gold is, if you look at John Exter, he was a central banker and did Exter's pyramid. And he was advising Volcker back in the day when he was having to raise interest rates really high. And John Exter was also a central banker in different countries. So he did the pyramid to show that gold and silver always are the ones that hold value, and everything else is a derivative. And depending on how the currency system goes, those derivatives can blow up, but the value always comes back. So when you were talking about 128 trillion, just flip the script. The gold market's going to raise to absorb whatever is crashing out of that 128 million. So we have a 50% revaluation in the global stock market. You've got 64 trillion. A lot of it's going to find its way into gold. Some will find it real estate and other things, but gold will be and silver. Talk about silver here for a moment. The gold silver standard is historically out of whack. It's over 100. That's not the way it comes out of the ground. In addition, you've got underlying forces on silver that are not being recognized yet, because silver is both a monetary asset and an industrial asset. We're running yearly, for the last 4 to 5 years, yearly deficits in what we produce out of the mines and what we have. So it's drawing down global stockpiles. And silver is not scrap recoverable in all cases. A lot of it goes into landfills in terms of a little bit's used everywhere. So the recovery rates on silver and the use rates on silver are much higher than gold. And so
Plus,
what's going to happen is
very few dedicated silver mines too.
very few dedicated silver mines. So what happens when you have a global deflation, all these mines like copper, lead, tin, zinc shut down, and silver's not being produced as a byproduct as much, it puts pressure on silver production for primary mines, and that's going to spike silver. And I think the upside in silver the next 5 years dwarfs that even in gold. Gold's going to go up. Silver is going to be many multiples of the move that gold makes. Now it's highly speculative in the meantime because it's industrial. So you're going against economic factors. But once that monetary demand comes in, if every person in the United States bought 1 ounce of silver, you bankrupt the worldwide known above ground, unclaimed or free silver reserves. Because once you take out all the ETFs and ETPs and all of that, all of that fund demand and the storage demand on silver, what's left over is not a lot of free float. It's this thin. And that free float is not going to service everybody in the world wanting even a tenth of an ounce of silver. It just won't do it. And so silver is going to go bonkers. And because silver is probably the single most important commodity in the world, industrial asset in the world, because it's used everywhere and there are no great substitutes, except for in certain cases, you're going to see an absolute explosion in silver and silver mining. It'll come after gold. Gold is the canary, it's the bellwether, and then it will go. And then at some point, silver is going to kick off. And when that monetary demand comes in, I think what you're going to see happen is a sovereign state panic about silver mines.
I was going to ask you that.
They're going to go try to grab it and say, oh, silver is so strategic. Control. And you're going to see capital controls.
You saw Russia,
controls,
what was it back
controls across the world on silver mines.
Yeah, I think Russia back in September, October timeframe, they decided to add it to their reserves.
Yeah, because Russia knows, even more so than oil. They have a ton of oil and they have a ton of gold, but even so more than that, they know what's going to happen to silver. And the Chinese know too.
So they're getting ahead of it.
The Russians are smarter on silver than the U.S.
It's kind of shocking that nobody else is following suit yet. But to your point, I think that we're going to start to see that.
Yeah, it's the case for silver. If you've been a patient silver stacker, oh my goodness, are you eventually going to be rewarded? It literally is what you could make with a small silver stack. You could make up more gains on that than you lose when your house price when it crashes. That's the potential for silver in terms of a multiple. So not saying it's going to happen right away, but that's the potential. And, as gold goes, watch silver. Silver's very quietly been creeping up.
Yeah.
And the silver miners are making money hands over fist. The average cost to mine silver is somewhere between 23 and 24, $25. And you're sitting at $7 profit margin on silver.
Yeah.
The primary silver miners are doing well. And eventually you're going to see that rotate into the mining indexes, and you've already seen it. I mean, the GDX
they're up 50%.
have done well lately.
Just since January 1, they're up 50%.
Since January 1, and it's all that profit that the gold companies were making for a year and a half.
But what's amazing is that the general institutional and retail flows still are not coming in just quite yet. They're starting to trickle in here the last week to 2 weeks, but they're not yet coming in. I mean, nobody's talking about it on the street. You can go to, a cocktail party. They're not talking about it. You don't see people lining up at your shop. Are you getting people who are lining up yet to buy?
Retail. So I actually run a bigger business now. So I'm the head of, I kind of sold my store out and worked for the company. So I'm head of operations for Kinesis Bullion USA. So now I run a national outfit,
Oh, I didn't realize that.
We coin our own stuff and we sell it and all that kind of stuff. And the bigger parties are interested. We had somebody come in and just buy, thousands of ounces of silver. The big parties, the average everyday retail in America is still selling. They're selling their jewelry, they're selling their silverware, all that kind of stuff, because they see these high prices of metals like, I'm going to take advantage of that. What they don't, and it may be of a need, and they may even know it's going to go higher, but they have to, right? Think about it. You have all these delinquencies and debt, and people need to pay that somehow. They're liquidating metals. But I don't think people see the real potential for the metals.
Yeah.
And when they see it, and the average everyday American's like, no, I'm going to sell my Xbox. I'm going to sell my car. I'm going to empty my bank account and go buy metals.
But I'm not selling my metals.
Yeah. And they're going to buy metals and not sell.
Yeah.
And all of a sudden that's going to reverse in the US, and all the scrap metal that these wholesalers are getting and just reminting into generic coins and bars is going to go away overnight.
Yeah.
And that's been going on for about 2 years, Gary, and that's been going for a while. And that's kept the gold and silver price down in America because we're net sellers. Well, what happens when people run out of that and they figure out, I want to be in the metals?
Well, they will at some point.
They will at some
They
point, and
will.
you're going to have 10 times more demand than you had selling pressure.
Yeah.
And that the prices are going to move so fast. And that's what Goldman's saying. That's what Goldman said, 4,500 gold. They're like, this is going to reverse. And when it does, Katie bar the door. That's what you're going to see. And you're going to see it in the mining stocks as well.
Yeah, I totally agree. Okay, so Rob, how do you see the relationship between gold and bonds evolving in the coming months and years, given the current trends? I mean, they both acted as safe havens during, previous times in the 60-40 portfolio. Stocks would go down and bonds would go up. And so there would be some coverage there to to your portfolio, but that's not happening anymore. They're both going down in unison. Bonds have been going down longer than stocks, but do you expect, as folks are looking for safe havens, that they're going to increasingly move whatever percentage, if they had 40% earmarked towards bonds, they might be shortening that to 35, 30, 20, I don't know, and looking for an alternative hedge and moving towards gold? Is that what you're seeing moving forward?
Yeah, gold is the old bonds. It's now the new bonds. It's the real safe haven. But I want to give your viewers an education on bonds. And I did this article twice. I wrote it once and I did a video once. We're at the end of a 700-year worldwide debt cycle. For 700 years, going back to literally olden times, any form of sovereign debt, interest rates have been falling. 700 years, through the medieval times to Enlightenment to Industrial Revolution to the Internet age to whatever we're in now, AI, whatever you want to call it. 700-year cycle has reversed, not only in the US, across the world. 700 years. For the first time, we've had a sustained increase across the world in bond rates. 700 years. We're not talking about just a US cycle. We're talking about the world went through an expansionary credit and monetary cycle for 700 years that's reversing. And how much does it reverse? I don't know. But what that means is we've overused resources, we've over leveraged, piling on top of one another from civilization to civilization across the world for 700 years, across capital markets, across trade markets. So the rotation out of bonds, I think, is going to be astounding, and it's going to be protracted, and it's going to last for a while. And it's going to be different than it was in 2008 or 2000 or even in 1980. It's going to be a realization that debt is not truly an asset in the long term, and that money has to come out of debt. We've got to reset our system and clean all the junk out until we can do it all over again. And in the meantime, gold and silver are going to absorb a lot of that value. And that's what you're looking at. You're not looking at a 50-year fiat cycle. You're looking at a 700-year worldwide debt has reversed course cycle. And what that looks like, I don't know. This is unprecedented.
Yeah.
I don't know that now you can look at it and just say, I'm going to look at 20 years or 15 years or 50. I think you got to look at the big picture and figure out. The world is figuring out that the debt system that we've been on is just not, it didn't lead to what we thought it would lead to. Now we're having all this deflation. Well, if we could just print money and print debt forever, why would we be in the situation we're in across the world? Well, you can't. And that's the realization we're in. You can't do it.
I certainly hope that the folks listening are heeding the warning of this global monetary system shift that is underway. It's producing birth pangs. We're all feeling it, but it's just getting started, and we don't know what the other side is going to look like and how it's going to impact, but it is going to be different, and everybody does need to be prepared. But I do want Join our quickly growing community and receive a free report titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. Consider upgrading for access to premium content, but even without premium, there's plenty of free content daily. So visit metalsandminers.substack.com to join us and explore. And thank you so much for watching this interview. Now, I'm positive that you've enjoyed the discussion that I've been having with Rob as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. All right, Rob, before we started filming, I mentioned our lightning round. We're going to finish off with that. I'm going to ask you to rank some assets as a buy or a sell by giving it a score of 1 to 100. So 100 is an extreme buy, 1 is an extreme sell. Then just give it 1 or 2 sentences as to why you take the position. We're in the lightning round, so we'll keep it quick and we'll keep it moving. Gotcha. If you're not following the particular asset, that's fine too. Okay. All right. So on a scale of 1 to 100 right now, gold, buy or sell, and why?
It's 100 because gold's the ultimate barometer of issues, and all the issues are coming to a head. And even if the big collapse doesn't come, we're going to have enough that people are really going to profit off of gold going forward. And it's going to offset their losses in inflation that they've had the previous 10, 15 years more than any other asset. So that's the one I would obviously recommend that.
Okay. Gold miners.
Gold miners, I would put them at a 60. I would go higher, except for the fact they're very speculative and you have to be careful, and the amount of information you have to research to be successful in that. However, even 1 or 2 winners in your portfolio could eclipse the gains you'll get anywhere else when they take off. So highly volatile, but highly rewarding, I think, in this scenario.
All right. Physical silver.
Physical silver, I would say right now an 80, give it a year or so, and it's 100. The gains in silver are going to eclipse gold. Now, the gains in the miners may eclipse silver, but with silver, you just have to buy silver. You don't have to pick your winners like you do in the equity market. So silver is highly speculative, like the miners, but it's easier to pick. So I would rate them just a tad higher.
All right. Silver miners.
Oh, that's a good one. This one's hard. I'll give it a 55 because I think the returns could be even higher than silver because it's leveraged. But you got risk. The risk is in picking the right ones.
But there aren't too many of them, so.
There aren't too many, so silver's much easier to do well in that space than the gold equity space.
Yeah. All right, copper.
Ooh, that's a good one. I think deflation first and then inflation. If you look at copper the next 20 years, it's going to be more in demand and we have less reserves. There's going to be a huge shortage. So I would say
let's call it for 2025.
2025, a 30. The next 5 years, a 90.
Okay. Yeah. Uranium.
Ooh, uranium went up and down, but the world needs uranium. I'd say a 70. I'd say over the next 2 to 5 years, it's the power source for the world.
Do you make a distinction between uranium and uranium miners?
Sort of, kind of, for the same reasons. They're speculative, and if you look at companies like UEC, they hold a lot of assets that aren't terribly productive right now. So some of the miners need much higher prices. So I would say uranium first, and then the miners.
Okay, so I think you said 70 on the uranium. So where
50 on the miners.
50 on the miners. Okay. Oil.
The same thing with copper, deflation first, then increases for the same reasons, although I don't think oil is as scarce as people say. So I'll put oil at like a 60, 65.
Okay. NASDAQ.
20.
Do you have a reason?
Crash coming.
Yep. S&P 500.
25. A little bit less risky than NASDAQ because tech is so overvalued relative to the rest of the stock market, but I don't think S&P is doing great in the next 5 years either. So maybe 25, 30.
Okay. Short-term treasuries.
Oh, I'd actually say they do pretty well. So if short-term is 6 months or less, I'd give you a 60 or 70. You're going to get return on it. If you go more than 6 months, I put a 0 on that.
Okay, so long-term treasuries, you're at 0 because of Do you have an articulated reason beyond that?
I think the U.S. debt system is going to crash and revalue, and I wouldn't want to be the guy holding the bag because you're getting, if you're lucky, 20 cents on the dollar at the end of it.
Very scary. Yeah. All right, now on a scale of 1 to 10, each point representing like 1%, 2%, or even 2.5%. Where do you see inflation ending 2025?
I'll put it 4.5 to 5.
Okay, so you think it's going to be a little bit elevated from here?
Yeah, and I think 2026 on, you could easily see double digit and beyond that.
Okay, so you had mentioned earlier. I mean, I'm stepping outside of this for a moment. You mentioned earlier you thought deflation was coming.
Yeah.
How do you see that squaring with
Yeah.
the inflation numbers you just gave me?
So deflation and inflation can both be used two ways. It can be used for currency purposes or for economic activity. So deflation in economic activity, but because we have so much currency out there and because everybody's dumping it, the dollar is going to quickly devalue relative to other assets, which is why the inflation is going to come home.
So stagflation is what you're calling for here.
Essentially, and then as the debt market starts to collapse, movement more towards a potential hyperinflationary episode with massive.
Oh, so you see a Weimar or an Argentina kind of a thing
Eventually,
happening.
It'll take a few years, but that's the way the dollar has to go. I don't see the dollar surviving in its current format.
Okay. So we'll have to have you back on here to talk more about that. All right. Lastly, we did briefly touch on the 60/40 portfolio. That has been the recommended portfolio allocation forever, except it's no longer working. And so in your mind, what's the recommended portfolio allocation? And would you include commodities and hard assets and precious metals and even miners in there today?
It's hard for me to recommend to anybody else. I don't want to get in trouble, but I'll say what.
Well, no, this is not a recommendation for anybody to take. Yeah. Just first of all, this is more of a general, I think this is the rough new framework.
Yeah. General market sense is that commodities will do well, but in a deflationary economic, the broad commodities, copper and oil, are going to go down first. And then as the rebuild happens, we get into at the end of the crash cycle into the rebuild, they're going to go up a lot. So timing matters.
Yeah.
Commodities in the next 5-10 years, extremely bullish across the board. Copper, oil, the metals, base metals, rare earths. Look at the rare earth war going on right now.
Yeah.
The commodity is very strong. So portfolio construction for me is, because I'm buying a new house, I have real estate wealth, but I don't really consider that investment. I'm buying it for shelter.
Yeah.
So I got to take out of the equation because I'm not expecting my house value to go up. I'm going to go underwater, and I know I'm going to be underwater for 5 years. It's okay. It happens.
Yeah.
So I would just say investment, real estate, stocks, bonds, lower, maybe up to 10, 15%. If you've got a position, like I had a position, I've liquidated most of it, but I could keep a little depending, I might pick my winners there. Commodities, precious metals, mining stocks, companies that offer value by manufacturing, businesses that are manufacturing based, I think could do very well. So that's where I would look at. I would look at things that are going to do well in a crash and rebuild type of cycle. And I would stay away from traditional 60/40 portfolio at just.
So if you're doing 15% in the first bucket, are you doing 85 in the second bucket? Or are you doing more like say 75 and then keeping cash / short term?
Some cash. Cash is king.
Treasuries for optionality.
Yeah, cash is king until it's not, and it gives you optionality. It allows you to buy depressed assets without having to take transaction fees. So if I held it all in gold and I had to sell and go buy something else, there's a transaction fee. So
how are you increasing that optionality right now? Are you up to 20-30% on your optionality, or are you only keeping maybe 10 or 15%?
No, I'd say that bucket's probably closer to 10 to 12 to 15.
Okay.
And I would say to pay my bills and to have some opportunity to buy some assets if needed.
Yeah.
The rest goes into gold and silver, because if I had more cash, yes, I save on transaction costs, but the cash is devaluing. So you have to look at how is cash devaluing and what are your transaction costs to get out of something a little bit less liquid like gold and silver.
Yeah.
So I would keep a bucket of cash, but I know my transaction costs of getting out of gold and silver are not going to be super high. It's going to be in demand. So that's why I kind of moderate between those two buckets. Cash is more emergency, short-term, liquid. Gold, silver is more medium to long-term, and it's okay if I lose 1% or 2%. Liquidating and rotating into something else, because it still is less than the inflation value I'm going to lose in cash in the next year to 2 years.
Yeah. Agreed. Okay. I appreciate all that detail. Thank you for coming on to Metals and Miners, Rob, and for being so generous with your time, analysis, and ideas. It's always fantastic to spend the time with you. Would you share a key takeaway that you want viewers to keep in mind? And then after you're done with that, let them know where they can learn more about your work and how they can connect with you.
Yeah, the key takeaway is always, as an investor or somebody protecting whatever wealth you have. I mean, you got to protect your wealth to live in today's world, right? It's not always about being rich. Sometimes it's just about having quality of life. always look for change cycles. Educate yourself on long-term change cycles, because it's the long-term cycle which will either prove out your ability to be solvent or lose everything. The short-term crashes can hurt. It's the bigger term cycles which hurt the most. Be aware of long-term cycles and learn to read them. It's worth the investment in time and education. And if they want to find me, simply look up the Freedom Report on Twitter or look it up on YouTube, and I'm there. We're doing new videos. It's been a while because I've been on the lobbying trail for a while. I haven't done a video in a while, but we'll have a video this week. Both update what's going on in Florida with the gold bill, and I'll give another view of the market. But I'm always on Twitter every day, so you can always find me there.
Okay. And you did mention that you have a new position with Kinesis, right?
Yep.
And so do you want to plug that?
Yeah, so we do. Kinesis has a lot of products. I handle U.S. bullion distribution. So if you go to kinesisbullion.com, kinesisbullion.com, we've got sales going on in the gold and silver people could take advantage of. We also do a lot of dealer-to-dealer business. So if you're a business, you're interested in discounted gold, silver, we have a lot of it right now. We've got gold, silver we minted a year ago that sat there that now we're selling at a discount to what the market is. So if you're interested in good prices on gold and silver, either as a dealer or just a retail buyer, kinesisbullion.com.
Wonderful. All right. I will have all that information up. It'll be in the description area for everybody to click through. Really appreciate you coming on, Rob. I love having our chats. Thanks for being here with us, and everybody else, thanks for watching.
Thank you so much. I appreciate it.
Join our quickly growing community and receive a free report titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio.